Hi folks, it's Adrian Dunchuk, CMT Charter Market Ignition, and welcome to today's Friday webinar. Well, a lot's been going on. Bitcoin has been taking a lot of heat. The markets have been starting lately to correct after very abnormally strong tie to the upside, even breaching some sort of like typical seasonal weakness on the S&P 500 side, on the Nasdaq side. And things have been looking fairly well to the traditional markets, which has pushed Bitcoin to the very depths of the correlation against the traditional stock market, which is interesting. And it doesn't happen frequently. It's very infrequent occurrence. And as a result, it's worth paying attention. And without further ado, let's take a couple of charts for a review, see what's happening in the markets today. The markets were closed for the Independence Day. Again, happy 4th of July, belated happy of July. 4th of July, 2-hour American friends right here. And well, let's take a look at what's happening ultimately, right? Because a lot's been going on. Like I said, if we take a look at a market summary, ultimately, Dow Jones Industrials, the market is yet to open. And we're looking at the state from the 3rd of July when the market was operating also on short-end trading day, with Dow Jones kind of like finishing at 39,300 points almost. S&P 500 with the new all-time high closing 0.51% up, 55.37. That's a pretty good record, if you will. Very good, powerful movement. All stocks in the green except for Dow Jones for the indices. There are major indices as well. Dow Composite, transportation, utilities, all in the green, it seems. And a little bit of a more mixed picture, for red colored indications here for the sector SPDR ETFs, for the consumer discretionary up 0.67%, while as a matter of fact, the other more defensive stocks such as the consumer staples as well as the healthcare and well, right there, real estate as well, that is a little bit more interest rate sensitive, obviously. They're all doing a little bit worse on a comparative basis with, for instance, when compared to XLY or even the strongest performer for the technology, XLK, 1.35%. Quite a strong push, quite a strong type of a movement, which is also seen in the major indices. Like I said, Nasdaq is doing fairly well. And well, going further, what is that we can see? CRB, which is the Commodity Research Bureau Index, out there strongly skewed and weighted on the energy side right there. Metals are doing fairly well. Precious metal, silver, 30.84 per ounce. Gold right there, 23.69, also rebounding, from the lows of 2,300. That's been the main tendency, kind of like the main floor so far. So it's a sideways oriented environment, although the sideways oriented environment doesn't apply to Bitcoin, since it's kind of like breached the lows. Between what was a floor since March until now. $56,000 seems to have been the strong bastion that once blown out basically took us a little bit lower, took us lower of a hit, and it also collides with this overall narrative that Bitcoin nosedives under 58,000, basically amid empty Gold's German government wallet movement. So they began selling as well the inactive holdings, from the empty Gogs over the last 10 years, because empty Gogs hack happened, as far as I can recall, in February 2014. That is what put ultimately, the bear market, to roll for 2014. That's what we're looking at, right? So the German government, to the best of my understanding, basically gave a green light to empty Gogs, kind of like liquidation of the funds, or just distribution of those funds. And imagine if 2014, basically, you were holding Bitcoin worth anywhere between $300, $400, $200, like it was in the very bottom on 2015 floor, right there, between $150 and $200, if I'm not mistaken. That is quite a wide ride. And so since 2014, things have changed a couple of zeros basically to the upside. Many people got extremely rich, and well, this is something to consider ultimately, as the empty Gogs selling pressure kind of like hits in, and the wallets the empty gox wallet dormant for a month showed activity with test transactions and potential asset distributions and increased selling pressures, which is exactly what happened right now. Okay, and if we go to share this this long-term Bitcoin chart, like I said, if we go to see what was happening right there, empty gox was happening right there with the February crash in 2014, which put us ultimately below the regions of here we are talking about this, right, below the regions of 200-day moving average ultimately, which took us into the very confirmed depths of the bear market, $150, $170, $200, $300, kind of like a year-long consolidation that later put us towards 20K region. However, regardless of the empty gox, regardless of those 80% bear markets that happened in 2012, 2014 to 2000, well, that was a little bit of a semi-bull market. It was a bear market. It was a little bit premature, if you will, because typically those bear markets, if you take a look, they do happen once every 4 years, right? 2013, 14, 2017, 18, 2021. As a result, right? That is putting for a little bit more expectations, understanding, expectation to consider, so that 2025 is probably the time for us to anticipate another peak, right? And if the 2025 is a time to anticipate peak, well, not only we are still with yet, a long way to go. There are a couple of reasons to expect Bitcoin in the six figures, which we're going to cover briefly in a moment. Although what matters even more is that, like I said, we have the ETFs coming up all the time, right? We have Grayscale, we have IBIT, we have Fidelity, we have ARK Investments with Cat Hewitt, and we have so much of this institutional demand right there. And at the same time, the supply shock, has come from the halving side, right? Because the mining rewards ultimately on the 20th of April were cut by half, and here we are. So the digital scarcity is up. The bull market is represented by this actually this red curve, right, representing this uplifting curve. It lifts up. It continues to move up, even though there is a little bit of local turbulence, also caused by this empty gox selling, right? So interestingly enough, if we take a look at a comparison of the seasonal patterns, for what was happening in the S&P 500, for instance, since 1949, and the Nasdaq Composite election year, with the seasonal pattern since 1971 for Nasdaq, and Bitcoin 2010 until the very recent data. And what's pretty intriguing is that typically S&P has this best 6 months and worst 6 months, kind of like a type of a division. Best 6 months that last anywhere between October, November through April, typically where before the sell and may go away type of a pattern starts propagating and being overused, maybe as a self-fulfilling prophecy. Not only, however, the self-fulfilling prophecy may also come into action this way. It typically conveys the message of a weaker period anywhere between June and June and November, if you will, June and September, in this very case, it's going to be May and November, for instance, May and October. Worst 6 months for the S&P, anything around it, the other half is far stronger. The most of the returns actually are aggregated, like I said, over the years since 1949, especially in the other half of the year, right? Anywhere between October and April, and that can be seen, like I said, with this overall kind of like a tendency for anything on the top upper left chart, that it's skewed towards the right hand side of the chart, right? It's skewed towards the right top corner. What it means is that there is a positive tendency for the market to go up, except maybe before the Q3, like I said, the year of 2024, which Jeff Hirsch, huge shout out to Jeff Hirsch, who's a godfather of seasonal studies, Jeff Hirsch actually marked 2024 with the purple, where the arrow is on top, with the purple line representing 2024 and how it deviates against the typical performance. We are at almost 15% of performance year to date. Right there, when compared with a typical performance of 9%, we are 6 percentage points higher than typically what we were looking at, in the situations where there was a down April and up May, for instance. Or if we compare that with all election years that lead us basically to anywhere between 7% annualized return for the S&P, which is the black curve right there, or even with the stock traders almanac aggregate cycle, the blue curve right there taking us to 8%, we are twice as high. We're twice as high so far. And since we are twice as high so far, it may mean exactly what Jeff Hirsch marked in a chart, that we may be due for a little mean reversion, just maybe, because we've performed so well. We've pushed, so well on the S&P side. We've pushed so well on the NASDAQ side. That is on the right top corner. Top left was S&P, top right is NASDAQ right there, as the title of the chart suggests. And NASDAQ composite, in the election year, that for the S&P is typically strong and stronger than quite stronger than any average at all. For NASDAQ, it's also extremely strong, right? Because if you take a look, it's right now anywhere around 18% year to date, versus the black curve of the all election years average, for instance, of 9%, were twice as high. Again, so just this taking us into the seasonally weaker quarter three is exactly what may cause a little bit of another reason why the market may be expected to retrace just a little bit, maybe going for the little mean reversion, just exactly what Jeff Hirsch says and suggests. And if you compare this typical period, because like I said, the top left hand side is S&P, and if you can take a look, April for May is typically, or April for June is typically a weaker period. Most of the curves on the first half of the year on 1949, 2023 for the S&P top left corner is actually tilted to the downside, right, when it recovers slightly or performs flat basically throughout the quarter three, and then it typically marks the lows in September, falling, declining in September and putting in a low in October, reversing in October, rallying November, December, January, February, March, and April, right, making it top where best 6 months performing. And then sell and may go away pattern takes over. For the NASDAQ, it's a little bit extended, because if you take a look, basically the best performing period, starts also a little bit earlier, right? Starts in October a little bit earlier, although it is extended and typically lasts longer, right? Since the markets tend to perform quite well into July, right? There's more positive tendency for the markets to go well from October until July. So we have two additional months, right? For S&P was, like I said, November through April, and then you also have May, June, or July as the arbitrary period for a little bit overextended period. So for the NASDAQ, you would have and can expect best 8 months versus worst 4 months. And at the very bottom of this picture, of this chart aggregation, again, big shout out to Jeff Hirsch. Make sure to follow Almanac Trader on X, on Twitter. He's a legend. He's a true pioneer, as well as his dad was late Neil Hirsch. Incredible work. And Bitcoin 1 year seasonal pattern for their article that we released on the worst day of the worst month of September is the only month that returns 6.5% on average gain, which means that buying in September, if you want, and closing in September, buying on the 1st and closing on the 30th is typically losing strategy historically when you did it over the last 14 years, if you will, since 2010 or 11. However, what matters more is that Bitcoin is very strongly similar to NASDAQ, to what NASDAQ does. It typically has this June, July, kind of like a late summer rally week, party week season that is actually taking us taking us into weaker, quieter, more silent Q3, typically as it happens for S&P on one hand, and for Nasdaq even more on the other hand. So the orange curve is the 2024 at the bottom of the screen. 2024 right axis is basically the orange curve for what Jeff presented. It was just a couple of days ago before this major crash that happened. Right now we're going to be slightly lower than the 40% mark, year-to-date performance. Although what matters is that we're following somewhat of a similar pattern to 2011 and 2017 when compared and averaged. And 2018, 2020, 23 for this cycle, ultimately, as the green curve, we also are kind of like we seem to be missing this slight summer rally. So even though there's a big stomp right now in the market, even though the market is bleeding, typically July performs fairly well, three times as well as June does on average, right? July is the month that actually returns. If we take it to this screen, is exactly what takes 8.5%, almost approximately, average return over the last 14 years, July 2010, 2024 for the data averaged, and this is Seasonex, right? So those are numbers, those are facts, those are evidence pieces. They cannot be undermined, they cannot be denied. So ultimately, July expectations are positive. Typically, July, like I said, adds another 8.5% approximately to Bitcoin opening price. So even though we opened, for Bitcoin, what was the opening price actually? Right there. Now it was $63,000 approximately. So you could take us anywhere between 67,000 as the end of the month type of an approach. We are observing naturally this local culmination of the downside. This local culmination of the downside that is taking us basically as low as $53,000. Ultimately, we got a decent slide anywhere from 74 with 28% depth of the retracement. That is a fairly big depth of the retracement, and all that happens while the bull market continues. This bull market continues not just because I say so. It does continue because the trends are moving upwards. This is exactly what matters. So it's not me saying that the bull market continues. I have no power or wisdom to decide that. It's the numbers, the market, it's the average statistics basically telling you. And this black curve represents the trend of Bitcoin, this 200-day long-term trend of Bitcoin. And as long as it's moving up, the bull market continues, the bull market resumes, regardless of the local turbulence, right? So any local turbulence with the arrows basically marked right there, pictured by these arrows, anytime we actually hit 200-day moving average, it caused fairly strong reaction to the upside ultimately, right? So 19,500, then later took us to $30,000. With a slide in September, which is where we issued ultimately the 2023 September dip, kind of like right there, the article with Jeff. It pushed us to $74,000 ultimately. So there is this uplifting tendency, so that if we see those retracements, those mean reversions to 200-day moving averages, they typically indicate that they are strong, decent, good buying opportunity in the otherwise rising bull market conditions. So buying the dip in the bull market is a winning strategy over time in hindsight. It doesn't necessarily mean it's going to be immediate, like a V-type reversal, and we're just going to rush over 100K like immediately tomorrow. It may mean that we're going to stay here for longer. The moving average is just going to flatten out a little bit. We're going to just transition to more choppy environment, because that's exactly what we're looking at ultimately, right? Because those seasonal studies introduce the concept of a slower, weaker Q3 period, and as long as they do, we can expect July maybe a little bit weekend pump right here, although ultimately September, August are two worst performing months on average. So I wouldn't expect any good performance in Q3, maybe except for July at all on average. And again, those are expectations set not on my guesses, but set on the numbers. At times, the numbers, they don't necessarily promise the future. They cannot guarantee the future, right? The past returns don't guarantee the future returns. However, what it means is that you have, by betting on the past data, you have better chance of accurate decisions, of accurate judgments. So if I were to recommend any education, I would definitely study the works from Jeff Hirsch, because he's an incredible legend in his own niche, and that's definitely something to consider. Otherwise, another interesting point is right there, right in front of our eyes, MVRV, market value, realized value, expressed in the z-score, so the number of standard deviations against the mean. And what we're looking at is the latest record of 0.72, 0.83, if you will. If we take a quick calculation, if you take a very quick calculation, because the typical warning area where the market peaked was 7.5. And if we take it 7, even let's take it more conservative, 7 divided by 1.72, right? This is gonna push us over 400%, multiplier, 4x multiplier from the current prices. If we were to expect the Bitcoin price peak and the current environment. So long story short, in order to peak, according to this very fundamental indicator, giving you the market load, the market cap against the realized cap is basically how much money there is in the market versus how much money was actually transacted. All right, so the summary of transactions on chain, and then we take a comparison against that, with the market capitalization itself. So by observing that, another way you're observing that is NUPL, which I'm going to show you in a second. Although by observing that, you ultimately can tell how much market bloat there is, how much market profit there is, how much market confidence there is, how much market liquidity there is. Okay, and we are 4x from the historical peak values, right? And those historical peak values, I mean, at times they went to z-score being 10, to z-score being 9, to z-score being 10 again, right? To z-score being 713 in 2021. So all of these spikes on the valuation, on this valuation method expressed in the statistical terms of the z-score of the standard deviations, ultimately inform us that there is no risk of, that there is definitely no considerable risk on the peak. We are nowhere near in the peak area, right? And because of that, we probably have a lot more to say on the upside right there. And even if we take it to just a little bit of a brief analysis for what's happening regarding the mining cost, the mining cost ratio right there is at 1.24, with the price of Bitcoin being at 55, 200, approximately 300. Now, with the actual mining cost at 7,500, 7,600, it seems, right? Arguably anywhere there is this higher threshold of profitability for the miners. The mining costs are higher than the price of Bitcoin. Well, this typically brings a lot of inconvenience to traders, to those miners, because they may be feeling entitled or encouraged to sell in order to cover for their operating expenses, for instance, for the business, right? For the mining business that they take. So in the best environment is basically when the miners are profitable. They feel very little pressure to realize, to liquidate their Bitcoin holdings. And as a result, it gives us a little bit less bearish expectations, right? When the situation is opposite, which is exactly what we're looking at right now, the Bitcoin mining costs are 70.5K or 70.6K, if you will, statistical roundup, against the price of Bitcoin of $55,000. So that's 15,000 per unit, basically, of underperformance, right? And that is quite a heavy job. The miners can go on for a little bit longer than just one day, on unprofitable days. However, like I said, ultimately, it's not convenient. It's not a convenient environment to be in. So if we are to give you a little bit, more recent price action, $64,000 seems to be the main area of resistance. It served as support before. However, it's it slowed down. The curve of the 200-day BPRO moving average is basically changing from the uplifting from the rising tide towards more flatness, with the 53 as the local bottom. That's like we mentioned. Now the systems themselves, my trading system has remained bearish since the bearish signal print at it was at 67,200, right? This is where I got stopped on the latest trade, 67,200. This is where we are right now, and this since the bear signal came in for the BPRO, we actually lost 21% almost to the very lows. Okay, that's quite a safe, and the latest trade I got was stopped on June 11th, which will have soon been 1 month. Let's take a quick look at how ETFs are doing. 314 billion cumulative spot Bitcoin ETF volumes for July the 2nd, with 89% market share belonging to the spot against the futures. So it's only minority of 10% approximately to belonging to the futures. So the futures are more speculation, spot is more kind of like long-term hold because it costs less, right? At the same time. So the spot market gives you exposure on the buy and hold type of a strategy, more passive investment for Bitcoin long-term value instead of doing the trading, if you will. The net flows slightly negative at 20 million from the 3rd of July. The market is led ultimately by BlackRock iShares IBIT ticker Bitcoin spot ETF with GBTC Grayscale at 15, almost 2 billion AUM less, and quite a difference towards the 3rd for third and common Fidelity right there, and ARK Investments it's 2.5. Okay, so well, the conclusions are the net flow is negative. It's the cumulative volume continues to increase naturally. 89% is the market, so 89% of the spot of the ETF value of the market share belongs to the spot, which is decent news. And the IBIT doesn't reduce much. A couple of weeks ago, they were above 20 billion AUM. So there is just a little bit of a withdrawal down to 18, down to 17.82 on the withdrawal side for the ETFs. And before we run, this is again a quick shout out for everybody who's brave enough to put their money where the mouth is. Ultimately, I did as I promised. I did load more Bitcoin to my long-term bags. There is a proof attached in the picture in the chat. And what I mean is that 20 to 30% discounts in a bull market are a gift, and they are only visible in the hindsight. So that's something to consider. And ultimately, let's talk about Ethereum as it comes for the critical point of another instance of the ETF approval, just maybe after the ETFs were filed for Sol by Van Eck and another issuers right there, because we are looking ultimately at the Ethereum at the bottom, Bitcoin on top right there. And what's critical is that there is not much difference per se, in terms of the type of a price action. It's very similar. They seem to be fairly glued together. Downward breach below the 200-day moving average, 200-day moving average of Ethereum right there, giving us a fair price of Ethereum at the level of $3,100 right now, approximately to $2,800 is a decent discount, if you will, right? Ethereum is 32% down from the peak of 4,200 towards the 2,800. That's a 32% decrease. Bitcoin is 28% decrease from 74 all the way to 53. So that's something to consider ultimately, because there's a little bit more relative strength on Bitcoin side instead of Ethereum. So when I got asked, whether I should invest more, whether I would invest more myself in Bitcoin or Ethereum, I would say I would invest more money into something that is stronger rather than what's weaker, right? The outperforming assets will continue to outperform more often than not. This is the principle of momentum investing. Otherwise, Ethereum, it's not looking bad at all, right? It's still on the uplifting curve right there. 2140 was the critical level back, back before the major breakout occurred. Actually, right there at 2140, a couple of like 6 months ago, 7 months ago. Actually, time flies very fast. We did manage to push all the way to almost 4200. Like I said, we're just retracing to the 200-day moving average, and historically doing so, or purchasing in the pullbacks of the 200-day moving average after a long series of deviations is a decent gift from the market, right? So if you see an asset just continue to oscillate, and there is this 200-day moving average, it is just going to go on, and there's a very decent deviation. And typically, the Fed deviates, for instance, in the measure of the z-score. Now, the Fed deviates against the 200-day moving average. That more of a probability, if you will, there is for a slump, for a correction. And as a result, like I said, if you see strong deviation against the 200-day moving average on top, this may be a signal for reversion to the downside. And on the other hand, if you see a strong deviation to the downside against the moving average, which is exactly what we're looking at right now, it doesn't mean we cannot go any lower. It means it's a deviation to the downside in an overall rising trend and tendency, which means that a train is leaving the station and is just pulled back for a moment, right? However, it overall goes higher and faster and better. Here is another instance that I referred to for Sol, right? Since Sol has been a very hot topic, ultimately for the ETFs as well, for the ETF files. If Ethereum ETF gets approved, that might be another signal for the Sol. And the entire, DeFi Web3 ecosystem to get ultimately ETF, if you will, right? Because if Ethereum, if is basically given as an ETF for spot, that might be a decent change for crypto. Otherwise, the 200-day moving average for the Bpro trend line for the Sol is right now kind of like stalling a little bit after a very long series of increase. Sol obviously pushed very strong and very, very hard. Right there, retracement from the 2010 to $210, all the way down to the local peaks. It's not even in the peak, or it's not even the truths. It's not even in the truth area just yet. $115, 210 down to 115. It was in April, and it was in May. We are hovering. However, it's showing some more strength, right? For Bitcoin and Ethereum, we actually broke the lows from that particular region. For Solana, it's actually staying a little bit stronger. So Solana is even better, right? So if I were to it's even better technically, but I can see it's not not necessarily as good in terms of the return side. So I would be careful with this one. So I wanted to say I would pick Solana, although I just realized that 210 all the way down to 130 is quite a deep retracement itself. So Solana, performance-wise, is probably the worst choice out of these three for now. So I back off. Although what may matter is that technically, like I said, there is this technical strength, as in there's the support that wasn't breached, right? There's the support we are closest here, to Solana, while for Ethereum, for Bitcoin, it's actually to the downside already. So technically, it's looking better. However, performance-wise, it's looking worse. So something to consider. Shout out to our partners at Soil. They are our partners, like I said, to take it with a grain of salt, anything I say ultimately, because I might be biased, although they're running an excellent RWAs platform right there with the entire DeFi mechanism for the institutions to generate the yield. And what matters here is that there is this continuous decline ever since March 2024. And more importantly, it's been indicated by the Birb Pro ever since the breach of 2.62, right? So since we broke 2.62, right there where the main indication was, we actually lost 72%, 71%. So there was a heavy defense, heavy loads of money saved by Bpro, basically, for anyone reading Bpro. And multiple warnings, we kind of like where we're also observing, there the key supported 1.7, 1.6 got broken. We're right now quite lower, 50% lower at $0.8 at 80 cents. Now with the bearish indications coming through, still the 200-day moving average, which is this curve is also rising. It's showing this downward deviation against the moving average, which may be considered the buying opportunity ultimately. We're in the previous area of interest where the previous kind of like peak was formed. So just maybe there's some polarity change principle that is going to ask and that is going to encourage some more traders. And if the markets follow through on that typical weak summer rally perspective with positive July, that might be a little bit of a call to a couple of altcoins to also pull back higher. Maybe that's exactly what is going to push us to, let's say, 1.4, which is now 1.2, 1.4, which is where the congestion of those important critical moving averages is. Something to consider ultimately. One or two last charts. Here's one from AZERO, also our partner. So that's a disclaimer so that you may take it into consideration. The chart is not looking good, to be honest, right? It's lost its floor at 0.72 some time ago at 0.7, peaking around $2 right there. And ever since, it's been a slaughterhouse, basically. It seems this way. Knowing their team, knowing the fundamentals, it's definitely heavily undervalued. However, technically, it doesn't necessarily guarantee that at the bottom can be anywhere soon, right? I mean, just because something is cheap doesn't mean it cannot get any cheaper. Although, like I said, this intrinsic value of the firm of AZERO basically is something exceptional, so something to pay attention as well. Although for now, the high time for trailers stop at 0.68. Right there is the critical level where you could expect some resistance ultimately. And in order to make it bullish and to mark it down as a one big deviation and one big kind of like an encouragement for the market to go up, at least to the level of 1.4, 1.04, I would expect us to close higher than 0.7 in the first place, right? That could be a decent validation for the market, at least to tilt to the other side of the edge of the range right there. And final shout out to Credefi, who are also our partners. And they are, ladies and gentlemen, right there at a decent support region, anywhere between the 3-day period, 200-day, 203-day periods, actually, from the BPRO trend line. So that's a long-term average, something to consider for the long-term trend. And the 200-day moving average, which is this light gray curve, coming anywhere between 0.15 and 0.17 right there. That is exactly where the Credi token is, right? So that's why I named it as a support pocket. The RSI continues to move down. This is a daily RSI with the 50-day RSI trend. Ultimately, we are below the 50-day RSI trend. Here is the proof right there. So the momentum is on the bearish side right there. The correction continues ever since April, since late March, April, with the key resistance at 0.0264, right? So we're in the support. We are far from resistance, maybe due for a little bit of a mean reversion to the upside on a similar basis to Soil and AZERO. Although, like I said, the markets tend to respect the trend, right? If there is a trend is your friend, and that's what typically may be considered to happen. And well, ladies and gentlemen, I just want to encourage everybody to respect the seasonality, follow the trend because the trend is your friend. Also, if someone tells you this is the end of the bull market, that's not necessarily true. If we were to peak at the current Bitcoin level, the current Bitcoin tokenomics, if you will, and the current environment of Bitcoin, we would probably have to peak at about 200K, 220K, gauging just by the MVRV on average to give us to print as a warning sign. So there's still strong evidence and factual, fact-based prediction to make, that if you expect Bitcoin to peak, it would have to be far higher than what it is right now. 20-30% retracements are decent, typically buying opportunity on the buy the dip scenario. And what else can I say? There is a lot to be excited about. Weaker, slower, quieter period coming. August bad, September the worst. Also, that generates buying opportunities, right? Because if September performs the worst, this is also where the biggest and the lowest dips are bought. And if you are lucky, if you persist, if you hold through this storm that is right there going on with the anti-GOX German government selling, encouraging the selling right there, then there maybe some decent reward coming right around the corner in 2025. late 2024. So there's a lot of things to be excited about. And I've been your host, Elias Dunchik, CMT, to talk about traditional market, to talk about crypto, and so on.